since before the summer break. We took a little bit of a break over June, July, August. So apologies if I'm a bit rusty, so bear with me. The next one I'm doing will actually be next Friday, which is going to be centered around how you can significantly reduce your tax. I think it's quite timely as we're coming up to, I suppose, tax deadlines and company year ends and stuff like that. It'll be next Friday at 1 p.m. So if anybody wants more information on that, we will be sending around the registration link, or feel free to link in with us after as well. Just to give people a quick introduction to who Alpha Wealth are and what we do, if you haven't come across us before, we run a financial services company headquartered in Cork in a place called Little Island. And basically our mission, as it says here, is to provide individuals and organizations with a level of service and advice which they would not have been used to before. So mainly we offer individuals, families, companies advice on all areas of financial planning, things like mortgages, savings and investments, retirement planning and pensions, protection insurance, tax reduction, and anything else within that space. We are a central bank regulated company, which is obviously very important. We've 8 qualified financial advisors here in Alpha Wealth who have over 60 years of experience between us. Currently, we've over 3,000 clients from all over Ireland, which we're adding to on a daily basis. And we've over 120 million euro of assets under management with Alpha Wealth under our clients. And I think the really important thing for our clients is that we are impartial financial advisors, which means that we're not a tied agent for any providers in the market. So rather than, trying to sell people policies that, that might not necessarily need, it's about, looking at our client's situation, looking at their financial goals and basically mapping out a plan and helping them achieve their goals. And if, that does come with putting plans and policies in place, we can source out the most appropriate, most cost effective and best options in the market for our clients. So just to take you through the key takeaways of today's presentation, firstly, we're just going to be focusing on money management, reducing costs, budgeting, and we're going to be focusing a bit on getting your money working harder for you. 2 things that I probably spend most of my time as a financial planner speaking to people about is planning for children's education costs and planning for retirement. We'll be on the back of that talking about, some ways that you can reduce how much tax you pay. And as I mentioned earlier, I will be dedicating a whole webinar to that area next Friday. And lastly, protecting your most important asset, which is, of course, your income. We will open it up to some questions and answers towards the end, and my colleagues are monitoring the chat box. So if anybody has questions throughout, feel free to pop them into the chat. I just want to remind people as well, if anyone is on the webinar, to just maybe mute your mic just to avoid any background noises. Thanks very much. So I suppose as a financial planner, when I meet new clients, I try to get to the bottom of, why they're talking to us, what their objectives are and what their financial goals are. And I usually come across things like, becoming debt free. I want to live comfortably month to month. I want to buy a property in, whatever many years time, and building up a nest egg or emergency funds or portfolios, as I mentioned earlier, saving for children's education or saving for retirement so they can retire at a certain age, or becoming what people refer to as financially independent, which is basically, I suppose, at least having the option at some point in your life to hang up your boots and retire, whether that's on a full-time or permanent basis, on a part-time basis, but at least having that option. Other things is like, ensuring my family will be looked after and reducing tax. Sometimes it can be a combination of all of the above, and I'm sure everyone on the webinar can at least resonate with a few of those. And what I stress to clients is that it is so important to have some kind of a roadmap on how you can achieve those, which is a financial plan. I don't really think it's an effective strategy to just, randomly be plugging amounts into credit unions and pensions here and there, hoping that they might allow you to achieve some of your goals. And there does need to be a clear plan, and that obviously is going to, I suppose, adjust as you go through your financial life cycle. And it is really important, I suppose, to find that balance between distributing your income between needs, wants, and saving and investing for your future to meet those financial goals. When we are looking to establish a financial plan with a client, we do start with the basics, and it's about getting into good habits, which are money. And I always suggest to people to maybe start with doing a monthly budget planner where they map out their income and their expenses. We can help people with this, and there's a really handy budget planning tool on our website for anyone that wants to look at that. I usually do suggest that people do it with some bank statements, as it'll give you a kind of clear idea of how you're spending your money and help you to establish a plan to manage your money. I think an approach that works best for people, if they have the scope to do so, is what I refer to here as the backwards approach. And the reason I say that is because I think what a lot of people do is they look at their income, then they look at how much their lifestyle is costing them, and they'll see if there's some surplus left at the end of the month to allocate to future planning. And look, we're all human, so unfortunately that's usually, I suppose, nothing or very little. So I think the optimal strategy is to, as I said here, take X, which is basically your income minus your essential outgoings like your mortgage, your rent, your loans, your bills, and your insurance, and then first get out of your account what you need to be allocating to meeting your future financial goals, whether that's putting money into a savings scheme or putting money into a pension, and then finding what's left, which is Z here, and how much you can allocate to lifestyle spending. Now, I appreciate a lot of people this won't work for because they might be left with very little, or maybe what they need to be allocating might be more than they can afford. And that's where Alpha Wealth come in, basically to help people I suppose, make the most of the money that they do have and reduce their costs to help them as best as possible try to achieve their financial goals. As I said here at the end, our job really is to help you increase your X's and increase your disposable income by reviewing how you're spending your money and reducing your costs, determine why, tell you exactly how much you should be putting to certain vehicles to help you achieve your goals. And obviously important to make sure that you've enough left over to enjoy life. So as I said earlier, really getting that balance right. So on freeing up some of your income, obviously the obvious one is to look at reviewing the costs that we're pretty much forced to pay for. And it's so important to review all of these things on a regular basis. Things like utility bills, obviously, which are getting a lot of coverage in the press at the moment, they're going through the roof. And, I generally recommend that people do really shop around when it comes to the renewal stage, particularly at the moment. My own energy renewal came up recently, and I actually rang 6 of the main providers and kind of, pawned them off against each other and really made sure that I was getting the best value plan out there in the market. I think people have a habit of just rolling it over, and you are going to be really overpaying by doing that. Looking at other things then, like insurance policies, again, car insurance, home insurance, health insurance, really important to shop around. And things like mortgage protection. I come across a lot of people who took out mortgages with the banks and were pretty much, or they thought that they were forced to take out the bank's policy, which was usually the most expensive one. And they can save quite a bit by reviewing that and looking to move to a lower cost plan. We find that the savings on mortgage protection versus the bank's policies can be anything up to €25 per month, which is quite a lot of money over the mortgage term. Another topical area at the moment, and something that people can really save money in, is mortgage interest rates and bank fees. And then you have things like the management charges on your pensions and your savings plans, something that a lot of people ignore, and policies like income protection and serious illness cover. And one thing I do stress to people is that the importance of dealing with an impartial company like ourselves is we can provide independent reviews of a lot of these things and obtain discounts that customers mightn't necessarily be able to get going directly to the source. So we can really save people money if they're coming to us and doing a review with us. Two of the main areas that I look at first to save people significantly in is the mortgage interest rate that they're paying and the health insurance plan that they're on. Now, interest rates have been significantly reduced over the past decade or so, and we're now seeing some of the lowest mortgage rates in the Irish market, with the exception of trackers. But that is starting to change, and interest rates are starting to go north again. So I think everyone out there needs to be taking some action to review their mortgage and making sure that they are locking in a low fixed rate while it is there. This is just an example I had with a client recently. This is a real life example of how we put over €8,000 back into one of our clients' pockets over the next 7 years. So I had a client with a Bank of Ireland mortgage with 32 years remaining on it, with an interest rate of 3% that was fixed with just less than 1 year remaining. Now, some banks will charge you a penalty to get out of the fixed period, some won't. So it's about, crunching the numbers and seeing does it make sense. For this client, the best option was to switch to a lender called Haven on a rate of 2.65%, which was fixed for 7 years. So their repayments were locked in for the next 7 years. So they were protected from any future rises in interest rates, which is what we were trying to do as well. And that lender was giving them €5,000 cash back. So their monthly savings on their repayments were 57 a month, or €4,788 over the 7-year fixed rate. They got 5,000 cash back, of which they had to allocate about €1,500 to legal fees, evaluation, and the penalty. So they were left with 3,250 in their pocket. As I alluded to earlier, we also reviewed the mortgage protection that they took out with the bank, and we shaved $350 a month off that, which is nearly 300 over the 7 years. So in total, between the savings on the repayments, what was left over from the cashback, and the savings on the mortgage protection, this person was coming out with over €8,000 back into their pocket by doing a very simple exercise. The other area that I mentioned is to review your health insurance. So studies show that 3 in 5 people overpay for health insurance in Ireland, and that's largely down to the complexity of the market and the amount of plans that are in the market. I think there's probably over 500 plans at the market at this stage, and it's really hard to navigate. So I've just simplified it really by asking people to do 3 things. First is that you're not over-insured. What I mean by that is, if I look at myself, I'm someone in my, I suppose, early 30s in generally good health. I hope I go to the doctor, at most once, twice a year. So the point I'm making is it doesn't really pay me to fork out €1,500 for a year for a health insurance plan where I can claim back on this and claim back on that and claim back on all these GP visits when I'm not making use of those benefits. All I really want is a plan that provides me with a really good level of inpatient benefits, which means that if I have to go stay in hospital, or if I have to get an operation, or if the worst was to happen, that stuff is covered. Okay, I don't really need all the bells and whistles. The second thing is to make use of online discounts. A lot of providers like Leia have a set amount of plans whereby they give you a 10% discount if you purchase them online, which is then removed at your renewal stage. So you just need to be a bit savvy in terms of how you purchase your plans. And finally, to make use of kids offers. Again, there are providers out there that have a certain amount of plans whereby if you pay for one child, all the rest will go free. I have come across so many clients that are paying, €250, €300 per child, and that could be by 4 or 5 kids, when they can benefit from a plan that they just pay one fee, and all the rest of their children's policies will be provided at no extra cost. So between the both of these, I suppose, areas, you can free up a significant amount of your income. Just leading into that, going back to, planning and I suppose trying to achieve your financial goals, I think it is so important to make sure that a portion of your money is working for you on a regular basis to meet those objectives and not working for your bank. I suppose the challenge people have at the moment is that any money that they have in banks, credit unions, and post offices is earning practically 0% interest. And the threat there, of course, is that, especially in times of rising inflation, it's causing a real loss on your savings, or a loss of purchasing power. You can see over there on the right-hand side just how inflation has impacted the cost of stuff over the last couple of years. Here is the price of a pint of Guinness, but, other things, I suppose, cars, homes, I suppose utility bills, education, everything is increasing on a year-to-year basis. You need to make sure that any of your long-term savings are earning a decent interest rate, which is at least matching the rate of inflation, to make sure that the value of your savings is not being eroded. For that reason, cash was never a long-term solution for long-term savings, and in my mind never will be. So it is really important that people invest a portion of their savings. And as I said here, we need to get exposure to growth assets to beat inflation and grow our money over time. This slide here just shows how devastating inflation can be over a long period of time. A lot of people perceive, bank, credit union, and post office as a low risk, or I suppose, vehicle that comes at no risk. And you can just see that the complete opposite is true here. So Michael, in this case, is 100,000 sitting in his bank account, earning 0% per year. And this just shows, I suppose, how inflation impacts the purchasing power of his money over a 15-year period. On average, over longer periods of time, we've seen inflation rates of, somewhere between 2 to 3%. So if you're looking at an inflation rate of 3%, he's lost over a third of the purchasing power of his money over a 15-year period. At the moment, we're seeing inflation rates much higher, 5, 6, 7%. So really important at the moment to make sure that a portion of your money is working for you. And the thing that people have to appreciate is that, your banks are delighted, because what they're doing is they're loaning out and investing your savings to make money for themselves. So they're making money out of us while they're charging us for the privilege. You just need to be a bit savvy and make sure that your money is working for you. There are loads of plans in the Irish market that allow your money to grow at a much better rate than they would in the bank, credit union, or post office. And one of the plans that I typically recommend and set up for my clients is one offered through Zurich. It's the plan I use myself for what it's worth, and it's called the Easy Access Savings Plan. It basically allows you the ability to save on a monthly basis from as little as €100 per month. You can also invest a lump sum of 5,000 upwards, or do both. And why I like this plan is, A, it's very flexible in that you can increase, decrease, top up, stop, and restart the plan at any stage. Secondly, it's accessible, so the term is completely open-ended. You can pull out your money at any stage at no penalties, or leave it there for as long as you want. But probably more importantly is it gives you exposure to a massive range of market-leading and award-winning savings funds from Zurich, who in my view are a market leader in the Irish market. And I'm happy to show people a bit more on that. They have many different funds that will fall under this kind of risk versus reward rating on a scale of 1 to 7. And this is something we spend a lot of time speaking to people about. And I want to stress to people that you do need to be taking on some level of investment risk with your long-term savings. And the level of risk that you take on is determined by, A, your financial situation and your financial goals, and B, the time frame that you have in mind. So for somebody who is young, in their 30s, 40s, saving for retirement, which might be 20, 30 years down the line, they shouldn't be concerned with being invested in risk level 5, risk level 6 funds once those funds are very well diversified and well managed, because over the long term, the value of those funds will rise, and it'll allow you to kind of ride out any of the short-term volatility that we do experience in markets. For someone who's saving for their kids' education, or maybe buying a property in 5 to 10 years, they might be looking at funds which are risk level 4, risk level 3, for instance. So it's about taking the right amount of risk and making sure that you are getting access to the best options out there. As I said at the start, something I spend most of my time speaking to people about when it comes to planning for the future and putting savings plans in place for is planning for their kids' education, mainly third level education, which we've really seen rise in costs over the last couple of years. Zurich actually do a cost of education study every year, and you can just see, I suppose, how much of a financial burden this is for parents. The lifetime costs of primary school can go up to as much as 12,500. The lifetime cost of secondary schools can go up to 15,696. And the big one, as I said, is the plan for third level education, which can cost parents up to €60,000 per child. Now, I accept there might be instances where it's going to be a lot less than that, particularly if your kids are staying at home while they're in college, but it is certainly, I suppose, a big financial burden for parents. And because of that, it's really important to plan for it, because what they've also found is that over 52% of Irish parents will rely on loans to finance third level education, which can really cause financial headaches or financial issues down the line. And that can really be avoided by planning early on and making sure that you're putting the right amount of money in the right places. This just shows the sum of money that can be accumulated for in an education fund, utilizing a plan like the Zurich Easy Access Savings Plan that I mentioned earlier, and achieving a really modest investment growth rate. What I usually recommend for parents is that they do save the child benefit of €140 per month into a plan like this. And you can just see here the power of compounding interest over a long period of time. By the time the child starts primary school, you could have €9,000. After 12 years, when they start secondary school, 25,000, or after 18 years, which is typically the time that they start third level education, you could have up to nearly €43,000 in your savings fund. Now, for people who are in the fortunate position that they might have a lump sum to add at the start, in addition to paying in the child benefit a month, you're looking at much higher figures again of nearly €20,000 after 5 years, €37,000 after 12 years, or €56,000 after 18 years, which I'd like to suggest would put a fair dent in those education costs. The other thing that I really want to stress to people, and as I mentioned from the start, we are an impartial advisor, and the benefit of using a company like us is that we're not tied to any provider, so we can make sure that people are getting access to the absolute best options that are out there in the Irish market. This just shows how, I suppose, Zurich's most popular moderate risk fund, a fund called the Prisma 4 fund, has performed over the last 5 years versus some of the other similar funds that are out there in the Irish market from other investment providers. Now, the first point I want to make is that this fund has returned nearly 34% over the last 5 years, and that's in a period where we've had a lot of challenges, you know, COVID, war in Ukraine, rising interest rates and inflation. And it just goes to show that long-term investors are rewarded if you're invested in a fund that is well diversified and well managed. And these funds can be really resilient over a long period of time. The second point I want to make is you can see how much it has overperformed versus some of the other providers. Irish Life, who most of the banks are tied to, similar risk level fund, has only done close to 17% over the same period. New Ireland, which Bank of Ireland are tied to, has only done 23%, and Aviva only 12%, whereas the Zurich one, in stark contrast, has done 34% over the last 5 years. So if anybody on the call today has a similar plan that they might have set up with another provider and thinks they are sorted, it probably is worthwhile reviewing that plan just to make sure that you are getting access to the best options out there. The second part of it is that you want to make sure that the charges you are paying aren't too high, because they can really eat into investment performance. I had a client actually earlier who started a pension with a broker in 2014, put in a lump sum of 11,000, and today the value is still 11,000. She initially blamed the funds, and I brought up the performance of those funds over the last couple of years since 2014, and they had averaged about 5% per year. So the reason her investment didn't rise in value was not due to fund performance, it was due to the high charging structure that that broker or that provider put on that policy. So it's just so important to know what you are paying. We would see ourselves as being a really low cost broker, and we actually cover the 1% government levy on these savings plans by giving our clients 101% allocation on their savings contributions. What I just want to lead into now is ways to reduce your tax. And as I mentioned earlier, I will be dedicating a whole webinar to this next Friday, but I just wanted to focus on some of it in the presentation today. So for me, there's a couple of ways to reduce your tax. The simple ones are things like claiming back on, you know, GP bills and health expenses and working from home, which I'll get into in a second. And then there are, I suppose, maybe more practical ways that allow you to claim back tax at a much higher rate, such as making retirement contributions or making use of tax back schemes such as the Employment Incentive Investment Scheme. The obvious way, the most practical way, and probably the best way for a lot of us is to make use of a pension. Pensions get a bit of a bad rap in our industry, and it's more down to people having, I suppose, bad experiences with individual companies in the past, or the complexity of pensions and the fact that people don't understand them. But if done right, in simple terms, they are just a long-term savings plan, and they are the most effective way of saving money over a long-term period and reducing your tax. And the reason for that is that if you're a top rate taxpayer, every €100 you put into your pension will actually only cost you €60. So you're shaving €40 off your tax bill for every €100 going into your pension, and that full €100 will arrive into the pension, which actually grows tax-free to your retirement, at which point you get to take a lot of it out as a tax-free lump sum as well. Revenue gives us quite generous scope with making retirement contributions, which is dependent on our salaries and our age. So you can see here, someone like myself who's in their early 30s can contribute up to 20% of their gross income each year into a pension and get tax relief right up to that level. 4 things that I do recommend clients should know when it comes to pension planning and retirement planning is, firstly, know what roughly the current value of your pensions are. Secondly, know what level of contributions are going into your pensions. Thirdly, where the funds are invested. As I showed earlier, there can be a huge difference between performance and different funds, and you want to make sure that you're invested in the right risk and reward level funds relative to the term you have ahead. And probably most importantly is what level of income are those pensions projected to give you in retirement. Statistically, people spend 20 to 30 years of their life in retirement, and pensions are the most effective way for replacing our income in those later years. So early planning is really critical. So what we usually recommend that our clients do with us is a pension projection, where we will basically tell you what you're on track to get in retirement, and we can then see if there's a deficit and put a plan in place on how you can make up that deficit. It's not a good idea leaving it to last minute. You know, I regularly get people coming to me when they're 60 years of age and they want to retire next year or in 2 years' time, and they're looking at a massive deficit in what they should have. And unfortunately, at that point, it might be too late to make up the lost ground. As I mentioned earlier, there is a lot of confusion out there as to how pensions work and exactly what can be attained at retirement by putting away I suppose a percentage of your earnings now. So I just wanted to run through an example that I had with a client recently. He was 30 years of age and he was earning a salary of about €50,000, which I think is just over the average salary in Ireland. And he was getting 15% of his gross earnings paid into a pension, and we were looking at a retirement age of 65. Now, this assumed that the contributions were increasing by 2% per year, which is realistic, as income salary levels would generally increase as well year on year. And it was assuming that we were getting an average growth rate from the pension funds of 6% per year, which again is very doable over such a long period of time. Now, for people who think 15% of their income might be quite a lot, what you do have to appreciate as well is you do get tax relief on that 15%. And you might also be in a company pension scheme where your employer is making a contribution. So you might have a scenario where they're paying 7.5% and you're paying 7.5%, and then you're getting 40% relief on your 7.5%. So it can be much more affordable than people think. But even if you're, I suppose, bearing the whole cost yourself, what this person would have been coming out with is a take-home pay of about €37,000, €37,222 per year. Or after they set up this pension, they were coming out with €32,723 after tax. So essentially what they were giving up is $4,500 of their take-home pay per year, but they're getting $7,500 per year to their pension fund, which is growing tax-free. So effectively, by doing this, they're shaving $3,000 off their tax bill each year. With the assumptions above, they're on track to get a pension pot of about $929,000 at age 65. What happens at that point is you get to access part of the fund as a tax-free lump sum, usually 25%, but up to a maximum of $200,000. So this person was on track to get the current maximum tax-free cash from their pension, which is $200,000. Now, what I have in brackets here is what the future tax-free lump sum would be in today's terms after you account for inflation. So it would more feel like about $100,000 today. The remaining $729,000 in the pot then is usually drawn down as regular income. A typical withdrawal rate would be about 5% per year. So in this case, this person was coming out with about €36,500 per year at retirement, or about €18,229 in today's terms. The state pension currently is payable from 66 and it pays an additional €13,000 a year. So basically, for giving up 15% of their gross income to retirement, this person was coming out with regular income of €31,229 from age 65, which is replacing 62.5% of their pre-retirement income with pension income. And to add to that, they had 200,000 of a tax-free lump sum in their bank account, which it can actually be used to supplement their income further. So this person could possibly be on track for replacing 70% of their pre-retirement income with pension income, for putting away only 15% of their income now, of which they get tax relief on. So you can see how powerful it is over a long period of time, not only from a tax reduction point of view, but replacing your income in your later years point of view as well. Some of the other things that I mentioned that you can claim tax relief on is things like medical expenses, certain dental expenses, health insurance, which is applied at source in most cases, of course. On a family level, you can claim back on certain tuition fees if they're over a certain level. Obviously, being married is very tax favorable because of the increased credits and bans there. And something that I suppose a lot of people need to, I suppose, put a bit of emphasis on at the moment, or particularly over the last couple of years, is what you can claim back under your job. And I have a little asterisk here next to remote working expenses. A lot of people now are working from home, and you can actually claim back. It used to be 10%, but it is now 30% on many of your utilities for any days that you were working at home. So if you basically add up your phone bills, your broadband bills, your energy bills over the entire year, and then apply a percentage to that of how many days of the 365 days you'd work from home, and then applies 30% relief to that, in most people's cases, it's going to be a couple of €100, if not more. So really great way of reducing how much tax you're going to suffer this year by doing a tax return at the start of next year and claim back some of these things. And if anyone needs a bit of assistance with this, look, we're happy to help. So feel free to reach out after. The final thing I'm going to mention under the reducing your tax banner, and again, something I can go into in a bit more detail on the webinar next week, is something called the Employment Investment Incentive Scheme, something that a lot of people don't know of. It's basically a revenue-backed scheme which allows us as taxpayers to invest in qualifying Irish companies, typically over a 4 to 5 year period. Now, there's loads of companies every year that will raise EIS capital because it's a very cheap and efficient way for companies to raise money instead of going to banks or like private equity firms or something like that. And there are some really solid companies every year that are raising capital. Some of the examples are over here on the right-hand side. There are a lot of early stage startup companies in that space as well, but there are some really established companies there. For example, one of the companies we're dealing with this year is around since 2013. The company is presently valued at about €15 million, and they've been really, really successful. The minimum you can invest with a company is usually about €5,000 per year, and any amount of money that you invest with those companies or company over that 4 to 5 year period, revenue will actually give you a tax break of 40% on the investment amount as a top rate taxpayer. And you also get a coupon from the company for the use of your money over that period. Now, it can vary depending on the company that you invest with, but usually it's in the region of about 20 to 30%. So in very simple terms, let's say somebody had €10,000 that they had suffered to top rate tax this year, and they could afford to put it away in an account over a 4 to 5 year period. What happens next year in year one is you can include that EIS investment in your tax return, and revenue will issue you with an immediate rebate of 40% on that investment amount, which is €4,000 coming back to you, making the net cost of investment just €6,000, or else they will shave it off your tax bill if you do owe to them. So you make €10,000 of an investment, revenue give you back 4,000. So essentially, you're only risking 6,000. Some people would look at it as, or your I suppose the net cost of it is €6,000. What happens in year 4 to 5, then company dependent, is you'll get your initial 10,000 returned, plus let's say a 30% interest from the company, which is 13,000 coming back to you. So all going well in this example, somebody would have made an investment which had a net cost of just €6,000, and they were coming out with €13,000 returned in 4 to 5 years time, which is a massive, double your money scheme if used right, but it is, of course, to pick a solid company. And our role as a financial planner every year is to look around at some of the kind of companies that are raising capital under the scheme and run our due diligence and cherry pick the top 2 to 3 companies that we feel are the strongest and the most solid in that space, and present them as I suppose, a viable opportunity to our clients under this EIS scheme. Again, we're happy to discuss that in a bit more detail with people who are interested in discussing it. Lastly, I just want to finish up on, I suppose, protection. And what I say here, refer to here, is protecting your most valuable asset, which is, of course, your income. At the start of the webinar, we stressed on the importance of being able to allocate your income effectively, and putting money to needs, wants, and future expenses. And all of that, of course, is being derived from our income. So your income is your most valuable asset. It's not your house or your money in the bank. And it's really surprising the amount of people that don't actually have their income insured. So if you were, for instance, to have a bad accident or a long-term illness that prevented you from working or earning an income, it can be quite crippling to people and their families. So what we would suggest there is to look at putting in place an income protection policy whereby you can insure up to 75% of your income per year, and it basically would provide you with an alternative income source while you're unable to work due to sickness or injury. And the great thing about it is that you can pick a term right up to retirement. So it basically insures you for your working life. And it actually allows you to claim 40% tax relief on premiums. I come across a lot of people that when they were taking their mortgages out with the bank would have, pretty much forced them to take out mortgage protection and a policy called serious illness cover, which firstly only pays a once-off lump sum to someone. So like if you're out of work for 20 years, there's no point getting 100 grand payout now and then nothing after that. So income protection can be, a great alternative to consider, which provides someone with ongoing long-term sustainable replacement of income. And it also provides tax relief on the premiums, which serious illness cover does not. So again, just important to make sure that you are reviewing your cover and getting access to the most appropriate options for you and the most tax efficient options as well. If anybody wants to discuss, I suppose, everything contained in the presentation today on, in a bit more detail and on a one-to-one basis, we do arrange financial planning consultations. We find from these consultations, we do save or make clients thousands of euros, ensure they're set up for the future and put their mind at ease. And the cost of those reviews are just €99 plus VAT. What it entails, firstly, is reviewing your current financial situation and plans. We'll then look at setting financial objectives and goals, as we said earlier, things like clearing your mortgage, planning for education, retiring early. We'll map out cash flow models to project your future financial situation. And then we'll put a financial plan together to hopefully make up any deficit and help you to meet your objectives, and try to identify ways to save you money, reduce your tax, and get your money working a bit harder for you. My own contact details are here on the screen if anybody wants to reach out following the webinar, and we're happy to discuss it in a bit more detail. But I will open up the webinar now to some questions if anybody wants to unmute their mic and ask a question.
Hi, David, it's Trish here. What are the steps to enrolling in that Zurich savings scheme that you mentioned at the beginning?
Hi, Trish. How are you doing? Thanks for taking the time to come on. Yeah, so what I would suggest is maybe just pop me an email there after the webinar, or I can drop you an email. We probably have your contact details from the registration, and I can talk it through with you, and we can set up the plan for you. So
Okay,
your only
great.
considerations really are how much you want to pay into the plan, which can be started from €100 per month, and where do you want to direct your contributions. And obviously Alpha Wealth can help on both of those bases. We can also do kind of savings projections for you. So if you have a particular savings goal in mind, in most cases it's planning for kids' education, we can tell you, exactly how much you should be paying into the plan to meet that goal.
Perfect, thank you.
No worries, thank you.
Hi Dave, just wondering what's involved in the €99 financial review that you mentioned.
Yeah, so I just went back to it there, Jamie. So basically what I typically suggest is that we get a meeting into the diary with myself or one of our other qualified advisors here in Alpha Wealth. before the meeting, we will send you an email basically with some questions to gather information on your current situation. That includes things like, your date of birth, your dependents, your kids' ages, your salary, and, your financial goals. We'll also send you something called a letter of authority, which you can sign and send back to us. And it basically allows us to get up-to-date details on things like your existing pensions, your existing protection policies. And we'll basically crunch a few numbers, do a couple of projections, do a bit of work on our side in the background, and we'll then arrange the meeting and we'll review everything together with you and talk about, what you're trying to achieve. And what I would usually do then following the initial consultation is send you a recommendation or a financial plan on, I suppose, some things that I believe you should implement to help you reach your financial goals. And it might be a case then of tying in another meeting or a call after that to discuss putting plans in place. And I suppose the key thing that I want to stress to people is Alpha Wealth are very much about creating long-term relationships with all our clients, Jamie. I'm not in the business of setting up a plan for someone and saying good luck to you. It's about ongoing engagement, ongoing advice, and keeping that relationship.
Yeah, cheers, thanks.
No worries, thanks.